raising the possibility that inflation could turn out to be higher and more persistent than we expect.
We are back. Sorry for that. GME is ripping. Watch that go.
Importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month, until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
So much background noise. Well, thank you guys for holding on tight. It seems like that this is a Hail Mary. We already called for a Wi-Fi extender. So that's going to have to be something that we are going to be crossing our fingers for. Thanks so much for holding on in there and smashing that like button.
The labor market who have yet to come back or who may face issues with childcare, perhaps they've retired early, any barriers that you see keeping people from the labor market as you consider full employment going into 2023. Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame, I think 1 and 2 years out, we're going to be looking at a very, very strong labor market.
Very, very strong labor market is not the word that apes and bulls want to hear. We have GME coming back down to its EMA.
The last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than a third of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that that would stop, and that in fact it would reverse over time. So we think we'll be seeing some of that. When will we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though. Although, as I pointed out at the last press conference, the timing of that is pretty uncertain, and so are the effects in the near term. But over time, it seems likely that these very specific things that are driving up inflation will be temporary. And we'll be on. We're going to be looking. We'll be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down. So I can't give you an exact number or an exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with our goals.
Thank you. Now we'll go to Elon Mui at CNBC.
Hi, thank you, Chair Powell, for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making toward your goals in order to consider tapering your asset purchases. In that discussion, you said that you haven't made substantial progress yet, but that you expect to continue to make progress. In that discussion, did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
So I expect that we'll be able to say more about timing as we see more data. Basically, there's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Elon, will depend on the pace of that progress and not on any calendar.
Thank you. Now we'll go to Chris Rugaber, AP.
Right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed? And are we only looking at longer-term inflation?
The Apprentice, appreciate your super and your message. Thanks for the continuous dedication to educate me, a dump ape. This is priceless to have such knowledge from you. Thank you, man.
Its index of common inflation expectations on a monthly basis. Thank you.
So we do tend to look at the longer term inflation expectations because that's really, we think, what matters for inflation. The shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good signal for future inflation if gas happens to spike and then go back down again. Yes, I think if you look at the broad range of longer term inflation expectations, they've moved up. They moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself sliding down, and you have a really hard time stopping that process once it begins. So that was a concern. So it's good actually to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were, and by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago, at a time when inflation was still anchored and at around 2%, or maybe even a little bit below. So the answer is yes, I think they are anchored, and they're at a good place right now. It's gratifying to see them having moved up off of their pandemic lows. And as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent with our goal. We think that's an important reason. If inflation expectations are not anchored at a place that's consistent with your goal, it's not clear why you would expect to hit your goal over the longer term. So it's important.
Okay, now we'll go to James Politi with the FT.
Chair Powell. Thanks, Chair Powell. Your economic projections today forecast 7% growth in 2022, unemployment at 4.5%, and core inflation of 3%. If those conditions are achieved by the end of the year, would that constitute substantial further progress in your mind? And kind of more broadly, when you look at the sort of median forecast for interest rates in 2023, showing not one but two interest rate increases at the time, is this kind of, can you describe the sort of tone of the discussion in the committee, and are we really moving towards sort of a post-pandemic?
IEST is asking, Andrew, did you notice when Fed was replying to CNBC, who was reading off a script? I did notice that. Thought that was kind of weird. But, CNBC, very interesting in how they still tend to drive their own narrative, even at this level.
The committee will make, and it would not be appropriate for me to lay out particular numbers that do or do not qualify. That is, the process that we're beginning now. At the next meeting, we will begin meeting by meeting to assess that progress and talk about what we think we're seeing, and just do all of the things that you do to sort of clarify your thinking around the process of deciding whether and how to adjust the pace and composition of asset purchases. In terms of the two hikes, so let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense.
Liftoff.
If you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%. And the projections, they give some sense of how participants see the economy evolving in their most likely case. And honestly, the main message I would take away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals. So the other thing I'll say is rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff were very far from maximum employment, for example. It's a consideration for the future. So the near-term thing is really, the near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress.
Dr. Dazzle is asking, what are we expecting to see from this, I suppose, mostly scripted news circus? What you're trying to understand is whether or not the mainstream media is paying attention to the different effects that affect the entire market, not only for the margin calls that will be coming soon for AMC and GME related matters, but because a downturn could end up affecting AMC and GME as well, which is why we're watching the entire market, along with what Mr. J. Powell is saying.
In communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations. And we expect to be in that business until we reach substantial further progress, and then have a decision. Again, I have nothing further on time. Wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress, we think. But we're making progress.
Can't see.
Humi is saying that AMC has nothing to do with fundamentals. First of all, that is the type of FUD that will eventually make it so that you don't even have to care what Adam Aaron is doing. If it has something to do with the fundamentals, then what does the leadership have to do with AMC, right? No, innately, that is a statement that makes it much more difficult to actually fight on our side. So be careful of that. But second of all, we're talking about margin call liquidity for all of these financial institutions, which is not the same as AMC being affected directly. But be careful of the downstream indirect effects.
2% inflation. In other words, does the FOMC have a look-back period, or does it plan to suppress inflation in outer years? Because over the next 3 years, you're going to be above inflation. So what is your look-back period? Does the committee have one? And if not, why not? And if they don't, why isn't this just flexible inflation targeting without an average in a range of 2 to 2.25%? Thanks.
So as part of our year-and-a-half long process, the review that we did and came out with at the end of that with the new statement on longer run goals and monetary policy strategy, we looked carefully at the idea. We've all read all of the literature around different formulas for makeup and things like that, and we concluded, and I strongly agree, that it's not wise to wed yourself to a particular formulation of that. So we did adopt a discretionary there's an element of discretion in it. It says that we will seek inflation that runs moderately above 2% for some time, and it's meant to create a broad sense that we want inflation to average 2% over time. But that under the old formula, under the old framework, what was happening was 2% was a ceiling. Because all of the errors were below, you were always getting back to 2%. So you were bouncing back and forth between 1.5 and 2, and we wanted them to be centered around 2. So that's the approach that we're taking. And you're right, it's not a formula-like approach. We were clear on that when we announced the framework. Was there another part of your question, Craig?
That pretty much answers it, Chair Powell. Thank you.
Thank you. Now we'll go to Michael Derby.
Thanks for taking my question. So I wanted to ask you about the reverse repo usage that we've seen lately. I was curious if you are at all concerned about the level of money flowing into the reverse repo facility, and do you believe that the changes in the Fed's rate control toolkit today will have any impact on that? And then in a related question, do you think that Fed asset purchases are taking too many safe assets out of the market right now and creating maybe some dislocations in the money markets?
So on the facility, we think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within.
Shoot, you guys are absolutely right. It's Power Hour. Just kidding.
Is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit, will that have any impact on, do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
It could have some impact. I think we'll have to see empirically, but it's designed to keep the federal funds rate within the range, and I do think it could have some effect on broader money market conditions below, as it relates to the very low rates and the downward pressures.
Okay. And do you think it will lower uptake on the reverse repo facility, or that's just not even really a focus of what the change was?
It's not. It's honestly, and the funny thing, you would think that it would, but we'll have to see. It's possible that would not be the case. That's going to be an empirical question.
All right, reverse repo is something that we've been asking for a while. Seems like he's dodging most of those questions. What you should not dodge is the like button. Those of you who have been helping them get up to 1,000, and then we're going to see Meatball do a trick you all have not seen before.
And your response to Rachel at the very beginning, and talk a little bit about how we should understand what full employment means in a world that, as you mentioned, is pretty roiled. All the data has been pretty roiled by the pandemic, and we're not really sure where EPOP is going to settle in. We're not sure where participation is going to settle in, and wages are already looking decent. So I guess I wonder what full employment means in this context, and sort of how you're thinking about those wage data.
Yeah, as you well know, there isn't one indicator we can look to, and there's no one number that we can therefore point to. We look at a range of indicators, and it's a very broad range. You can count to a high number just quickly, but certainly it will include things like unemployment and participation and wages and many different flavors of that. So how do we think about it? A couple things. We're all going to be informed by what we saw in the last cycle, which was labor supply outperforming expectations over a long period of time. Now, that hadn't happened in many other cycles, but this was a very long cycle. So we're going to have to be alert to see whether that can happen again. It's a different economy. We have had a slew of retirements, and that may weigh on participation. That effect, though, should wear off in a few years, and as you move through that window,
I'm feeling real awful about the internet connectivity. So since that's not going to be an issue anymore, I can already expect we're going to give back to you guys by having another round of giveaways every 1,000 likes. So at the 1,000 likes, we're going to do a first giveaway, then 2,000 the next one. So it'll be stuff from the merch store or one-on-ones with me and Professor Meatball. It's just a thank you guys for holding on with us, and let's get that like counter up between the two of us.
At the Fed. And 9 years later, 8 years later, we were still creating jobs, and it was quite remarkable. So we're all going to be informed by that. At the same time, we understand this is a different economy. The demographics people are getting older, and that should have a secular effect of reducing participation over time. So we have to be sensible about what can be done. But I think we're going to lean into that and be optimistic. You asked about wages. We're seeing wage increases. That's sort of a natural thing to be seeing in a strong economy. And what we're seeing is that we don't see anything that's troubling, in the sense of what would be troubling would be very wide across the economy, wages at unsustainable levels. Without high inflation. In other words, wages in excess of productivity and inflation by a meaningful amount broadly across the economy, sort of forcing companies to keep raising prices and getting into a wage price cycle. That's the old formula one of the old formulas for having high inflation. We don't see anything like that now. We do see high wages. We see them for people who are mostly new, entering into new jobs, many of them in low-skilled jobs, and we do think you've got a thing in the labor market right now where supply and demand are just not matched up well, and we think it's a flexible economy, and it will clear. There will be a level at which supply and demand meet, and we think that'll be happening in coming months. So, but the last thing I'll say is, again, if you look at the forecasts, we're going to be in a very strong labor market. Pretty quickly here. There's still a big group of unemployed people, and we're not going to forget about them. We're going to do everything we can to get people back into work and give them the chance to work. But there's every reason to think that we'll be in a labor market with very attractive numbers, with low unemployment, high participation, and rising wages across the spectrum. So that's a little bit how we're looking at the labor market.
Thank you. Now we'll go to
The thing about Jerome Powell is that, he thinks those numbers are very attractive coming up soon.
So you're thinking around the supplementary leverage ratio right now. Is the Fed still thinking about ways to permanently adjust this to account for the high growth in deposits? And do you ultimately believe a permanent fix is needed? And any information on the timing around that would be helpful.
I can say is we're working on it. Don't have anything to share with you in terms of the particulars or the timing right now, unfortunately, but we've always, our position has been for a long time, and it is now, that we like the leverage ratio to be a backstop to risk-based capital requirements. When leverage requirements are binding, it does skew incentives for firms to substitute low-risk assets for high-risk ones. It's a straightforward thing. And because of the substantial increase in reserves, treasuries, and other safe assets in the banking system, the SLR is rapidly ceasing to be the intended backstop that for our big firms that we want it to be. So we do think it's appropriate to consider ways to adapt it to this new high reserves environment, and we're looking hard at the issue. We would also, just to be really clear, we will take whatever actions are necessary to assure that any changes we do make or recommend do not erode the overall strength of bank capital requirements. Oh, sorry.
John is asking if hedge funds would like to pay interest, millions of dollars of interest for these shorts over a decade, they should go ahead and undo it, but it does not affect the AMC prices. GME just took 219, getting heated up here. The shorts that have already caused their negative downward pressure does not continue to build negative pressure after it first was shorted. It's just an obligation that they now have to pay back.
Worried at all if we're going to end up with
GME has just pushed 220 as the it's not even the daily high. It's just another attempt from GME's side to push at 220
out of the pandemic economy, and I wonder how that would affect the Fed's outlook at all.
Well, that is really not the problem we're having right now. But actually, people who work in commodity industries are very focused on that because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I mean, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is we need to. Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors.
Everyone's talking about this sick, nasty cup on GME.
We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because if they are, people will build new hotels. There's no reason for supply and demand to be out of whack in the hotel business over any period of time. So we think that'll happen. I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really...
AMC has caught the positive uptrend and now has recontested its volumetric weighted average price.
And persistently so. We wouldn't hesitate to use our tools to address that. That's it. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business, and we're very much attuned to the risks and watching the data carefully. In the meantime, I would say, we should, as I mentioned earlier, there's so much uncertainty around this. It's just a unique situation that we need to see how things evolve in coming months and see how that story holds up and act accordingly.
Thank you. We'll go to Howard Schneider at Reuters.
Howard Schneider, Reuters. Thanks, Chair Powell, for taking this. I don't want to miss the moment here, and I noticed that in the statement you dropped the language saying that the pandemic is weighing on the economy. So is this the effective end, in your view, of the pandemic as a constraint on economic activity, even though it's still cited as a risk?
It's a continuum, right? What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And that should continue. But you also saw in the United Kingdom, which has, I think, at least as high, if not higher, vaccination rates, they've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and that can only help. You're right. The statement language is evolving. I would expect it to continue to evolve. There's a lot of judgment in that, but you can expect us to drag our feet a little bit on that because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say it is so great to see the reopening of the economy, though, and to see people out living their lives again. Who doesn't want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
If I could quick follow-up on that. If you view the statement in toto and the dots and the steps as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand. We've also seen inflation above target though, and I think even though in our forecasters' case, they do see inflation coming back down over 22 and 23 into areas that are very consistent with our mandate. Nonetheless, the risk is something that can factor into people's thinking about appropriate monetary policy. The thing is, these are 18 different forecasts, and I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well, factor into our forecast as well.
Hyperinflation. Luke Williams said something about Ortex bumping the short squeeze indicator on AMC. I'm going to go take a look at Ortex. I checked their Twitter. They didn't say anything.
I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you thinking about that?
What we're seeing in the near term, again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, supply.
Max Lewis says maybe it's not inflation, but that USD to CAD 2-year graph, and Canada is way behind the US on vaccinations.
By 2023, those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is a way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change of the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and it's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do, but I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had and thinking that I have more confidence that we could see inflation above 2%, that it may not be as hard to do that as we thought, and that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you. Now we'll go to Greg Robb at MarketWatch.
Hi, thank you for taking my question. Chair Powell, I'm just looking at the forecast, and one thing I just don't think it's been talked about all that much is how much the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
Looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. So, but you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022 and 2 to 2.3 in 2023. So you're right. You're seeing. I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year. Coming on the back of a 7% growth year, that's a really good year. That's a year with a lot of momentum. That'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right?
The economy's not the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question a different way, is there a risk that inflation will be higher than we think? Yes, as I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combined with demographic changes that have already been in effect, to suggest that that longer-term neutral rate, or R-star, might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long-run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount, and that would be a good thing from the standpoint of the economy, because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You can't estimate it with great precision. I think we would be alert to, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest, and we try to keep up with that, and I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great, thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street. I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period in which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think that there's nothing wrong with the framework, and there's nothing in the frame.
Yes, this guitar is a prop for a cool Kiss Jim Simmons costume.
Our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're certainly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we've written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is how do you...
Thanks, Flipperman, for the opinion. Remember, your First Amendment rights is that you can say whatever you want, but the fact that you're saying it here is all up to the mods. Respect the mods. Thank you for keeping the chat safe. Throw some rockets in the chat for them right now.
Due to particular things. A classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember it, there was prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that.
Nick Lopez would like to get a green name. You just have to press the join button next to the subscribe button. If you're on iOS mobile, like an iPhone, I don't think that will work. So you have to get on a browser like Chrome or Opera or Firefox.
We will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
Right, and
that's right.
we have to balance the two goals: maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole. An unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're gonna watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you. Thank you, Mr. Chair. It's Powell Hour. We are in the last 30 minutes. Oh, okay, good. I'm just like, the last 30 minutes of Powell Hour is now become not Powell Hour. It is the Powell Hour is over. But Power Hour still has 30 minutes left. That's the problem with these L's and these R's. As a reminder, guys, we pay attention to that options chain. So let me pull that up for you to see whether or not we can have a better understanding of where that gamma squeeze is. Locate where it is. Control F. One of the things I wanted to say again is thanks for all of you that had made today's streaming nightmare possible. It would have been much worse if we didn't have the Moon Platoon. So big rockets in the chat for you guys, and every 1,000 likes because of 100,000, right? 100,000 is not a meme. Thank you so much once again for Tyrick Bell for sending this shirt, right? It refers to the 100,000 subscribers. Also refers to $100,000 for both AMC and GME, not a meme. So for that, and because I just want to have like a good feeling every time we have technical difficulties. So each time we have those technical difficulties, we're going to do a giveaway, which means every 1,000 likes on this video, we're going to be giving a giveaway for something in the merch store. Oh, please don't tell me there's something. Please don't tell me that I'm lagging right now. Oh, okay. Let's look at the options chain while we still can. So yesterday we had some deep in the money calls. We listened in on whether or not this is going to continue being the same issue today. It is another $21 million worth of calls at $40 strike. If we have connection issues, I'm going to tell you right now that I'm just going to make one of the best analysis videos you've ever seen after this and upload it later. You guys watch it later. But we are right now hoping, crossing our fingers, that we're going to go all the way into after hours, right? I was hoping to go like maybe half an hour, 30 minutes, maybe a whole hour into after hours. Bring back the old smooth, the smooth melodies of Andrew Mo Money After Hours. Here we have $21 million worth of calls right here. From today at $40, and add that on top of $34 million worth of calls at $40 strike. These are both the same strike price and deep in the money. Both circumstances. Max Lou says maybe it's not inflation, but man, oh wait, that was a very old. That's a very old super. AMC is currently down 8.6%. So we are looking at the price of the stock with curiosity, right? We had only positive catalysts for the past day, as well as 500,000 calls expiring in the money. Of course, that's probably getting closer to around 400,000 flat. At the same time, we're looking at more and more attention being poured into these stocks as every day moves on. So right now we're waiting on whether or not the other shoe is going to fall. Oh yes. Do you still have that? So I posted on Instagram, Andrew Mo Money, always be plugging, of the of a very cool thing that one of you sent in the PO box in the description. One of you made a donation in the name of Professor Meatball. Look at him. He's like, me? I donated to a food place. So here it is. Just want to show it off real quick. Kent Kunin. Okay, and then back to the stocks. A gift has made to the Treasure Coast Food Bank in honor of Andrew Mo Money and Meatball the Dog by Kent Kunin from YouTube user UK7769. Cheers! Thank you. Cheers for the good that these apes are so capable of doing. Sean Machado says, misspoke earlier, Andrew. I won't be exercising my calls this week for 700 shares. I'll be exercising for 800 shares, helping Gamma squeeze diamond hands. Sean Machado coming in, taking advantage of those tasty calls and exercising them to help the squeeze. Boom. Oh man, where is Ja? Where is he? He was in the chat. Still in the chat, I think. Pretty sure apes have more than 80% of AMC by now. Thoughts? Yeah, I would say so. He's referring to the last Gamma squeeze where we had speculation of just how much ownership AMC was apes and how much of AMC ownership was non-apes. And so far, if you do the math correctly, we have 4.1 million apes controlling the entire float. Cool donation. Ja is dead. Say it isn't so. I just saw him in the chat. No. Let's see. AMC is not a dead cat. Bamboonicorn says, here's one of my favorite ramen noodle recipes. Sweet. Oh. Oh, man. All right. Let's see the uptrend that GME has been tracing the entire Fed talk. Look at Orphazyme, back at it again. 70% up on the day. Orphazyme has another near triple-digit percent rip on the day. It's just not done with the... there should be a whole, there should be a whole channel based around just Orphazyme, because this is a stock that is heavily rooted in the medical community, heavily rooted in biopharma, and also riding massive waves, 100% up one day, then 100% down, etc., etc. Right now, so sincerely ran away with the times here. I wonder how quickly that happened, because I was looking at what's on my left side pretty much all day. Now I want to be able to say GME had a good run all the way up to 221, and now back down underneath its 219 level of resistance, having a hard time crossing back through. There is another 20-ish minutes or so for it to do so. AMC currently trading at 53 and bouncing between its volumetric weighted average price and its exponential moving average. Nick Lopez, welcome to the Special Operations Infantry level of the Moon Platoon. I'm happy to have you join Professor Meatball and lead you to Valhalla. Sergio Salgado, yes, I'm back. What's going on? 220 and 54 proving to be hard resistances, conceptual logic. I think that when there are walls, there is more manipulation to be uncovered, right? Hard resistances is one thing, but just to have a pure wall of price action above a certain threshold, that's a different issue entirely. Okay, we are actually 200 likes, so 200 subscribers away from 107,000. If we can get to it on this stream, we'll do another giveaway right then and there. So 200 more people out of the 2,200 of you currently in here. I think that that's going to be doable. I think that shouldn't be too hard. Should be doable. Let's see. Fed day or FUD day? Okay, I'm gonna change my title real quick. So it seems like Jerome Powell didn't end up doing too badly today. We'll chalk up what he said later. Shorts are everything at AMC. Down on the day, -8% so far. That's actually not so bad. Okay, looks like we have a new Mo Monkey mugshot Marley. Welcome to the Moon Platoon. Happy to have you. Samuel Etnoye saying, Andrew and all of you apes, love you all. Y'all are my second family now because we are in this together. Now we have the float and power to be next. Rocket, rocket. Dun, dun, dun. Bo Gumby says, hey Andrew, just wondering when I'm going to get on your wall. Well, Bo Gumby, how about right now? How about right now? You never know what message you're going to be immortalized, though. So it's your message that gets immortalized is just a message of when you're going to be on the wall. Well, you're here now. Uh-oh. I would like you to, but it looks like YouTube does not want me to. There we are. Okay. Just 19 minutes away until the end of the day. AMC did push hard above the $54 resistance line, then got stuck once again at the exact same level it was rejected at earlier. This is giving me anxiety, not bad kind of anxiety, but like trepidation, because I am both more sure than ever that the true price of AMC for the level of manipulation before and now, because they are cornered and getting real tired of keeping the price level low, I'm assuming the real price of AMC cannot get lower than $50 because of just sheer how many resistance levels are being built just today. Look at this one. That is 3 touch points if I've ever seen one. 1, 2, 3, 4, multiple times touched here and here. So AMC has just added 2 brand new resistances. Wait. This one might not be. This one only has two touch points. Remove this for now. AMC is on a runaway. $55 and moving. 19 minutes to go, and it could just make it all the way up to $55.75. If it does and has a clean break over it, then $60 is within reach. Hey. Also licking. Ja Rule, LOL. Who is the real question? How is the quadruple witching going to affect AMC? Well, expectations mostly, right? If people expect that AMC is going to have a massive day on Friday because of the sheer amount of volume of the calls expiring in the money, well, you might just have an opportunity to sabotage that expectation. AMC did do a clean touch to $55.75. We needed a break, but now AMC on its best behavior has made up almost half of the dip from earlier today. Watch the RSI. It is getting dangerously close to 70 now. Actually, no. That was a few minutes ago. It is now over 70 at the highest it's been for the last 2-3 hours of trading. Okay, let's see. Remember today, AMC gave you a fire sale all the way down to 51.86. Now it's an opportunity for you to think, that dip seems like I have the chips to go along with exactly that. GME has the opportunity to finish green on the day, just down 0.08%. If it hits the next level of resistance, it will be green, clean and green. Morgana says, let us all stand. I'll do a little bit of standing just so we can show off the shirt a little bit more. Okay, it's not a meme. Bam. Meatball, come on, we gotta stand. Stand with us. Wait, don't move.
What a good boy.
What a good boy. Don't move. The tricks are coming out. Both of the boys are standing. Sarah, welcome to the Moon Platoon. Pleasure to make your acquaintance. You are now a Special Operations Infantry member of that Meatball Army. Steve Valenzuela says, does this math make sense? Yeah, there's about 2,300 of you, only 800 likes. You're right, that does not make sense. We got to make that math make sense. You know what to do, guys. I'm standing! I was like, how can I stand any longer? Power pose, guys. GME has now hit that green mark. 222.24 is the brand new high. GME is now green on the day. Meatball needs 4 figures, y'all. Aw, everyone's saying likes for Meatball. I wish I wasn't wearing pants. That would be a completely different issue.
Oh wait, never mind.
Oh, verify it's you. To continue your session, complete a brief verification. This extra step keeps your account safe. Okay. And whoa, GME just ran away while I was reading that notification. We have 225 on GME. GME doesn't look like a ton, but a strong break off of 222 is exactly what we were waiting for. Thanks, Meatball, for standing. We stood for the stock. We're gonna stand again in just a second. Let me just verify. 1,000, we did it. Like, again, I wanted to show my appreciation for you guys coming through, even though we had some hedge fund related effery today with our network connection. So I wanted to be able to throw out some giveaways for you guys for, once again, 100,000 subscribers. Let's get on the way up to 107,000. That's today. We need 200 more to subscribe to this channel right here. Patty Randawa, love you, Meatball, so much. Which reminds me, what is the name of Professor Meep? This is the hard trivia question, right? Whoever gets this right, we're gonna have the top 10, and you guys are going to be put in a random number jumbo, and we are going to pick one of you to win a t-shirt from the merch store or a 30-minute convo with the two of us. 226.20, 226.40. And here's the question: what is Meatball's name before I adopted him? Yes, this is, I've only said this once in a previous live stream, so hopefully you guys took notes. You don't even think you know, right?
No, I do know.
Okay, good. 228.09 is the brand new high. AMC also facing a resistance at 55.75 and stopping just short of it. Carrot for Meatball. Carrot. Bye. There he goes. GME continues to go. We have one person getting the answer right. Hold on, I'm pretty sure.
Whoa.
Yes.
Really?
Yeah, because I've said it before. All right, people are like, his name was Bill. His name was Meathead.
His name was Babe.
His name was Babe. His name was Baby Cutie, and that is correct.
What?
Yes.
Oh, I thought it was like kissing. Okay.
No, his name, I might still be able to pull up the tag. Yes, I did say it out loud. So those of you who have not yet answered or want to answer again, go in the chat because you still have a chance to win. So these are the people that tried last time around. We're going to start a brand new list of people. Whoa. Sorry about that. GME continues to rip. 228.60 is the brand new high of the day. Okay, so the first person that got it right was Craig Robles. And we're gonna do let's see if there's two. Oh, I need to just copy paste it, yeah. So they're like Doge, Jerry. Yes, a bunch of people have getting it. Good. Charlie. People are like Charlie. People just jump on the Charlie boat. Charlie? I can try and see. Let me try and see. Let's see. Charlie. Remember, his name was not Charlie, but we do have one indie tech consultant got it with Baby Cutie. Okay. Backseat driver got it with Baby Cutie. We have Lori Blanks. All right, wait, GME is still going. Tell me who I skipped. Koki Baruka. Terry Rose was before. Terry Rose, Corey Rose, and these are all people before Indie Tech Consultant, right?
Oh, well, I'm going straight from right after Craig Robles.
Okay, cool. All right, anybody else? 'Cause this is going to be it. We'll give Mike Harrison a chance too. Mike Harrison and Evan Fujimoto. All right, GME was on a massive rip sesh. GME has been under the thumb of these put walls for a long time, but ultimately we knew that they were going to expire, right? There's only so much negative downwards pressure you can do with those put walls, so that they either need brand new ones or they need to up their game. They've already are desperately trying to beat back AMC. Doesn't seem like they can try and beat them back at the same time. So let's put them in a choice generator. Random choice generator. Separated by commas. 3, 2, 1. Backseat driver. Backseat driver, you just won something from the merch store, a t-shirt or a 30-minute conversation with yours truly and Professor Meatball. So send me an email at andrewmobusiness@gmail.com and we are back to the markets. Thanks again, guys. We're doing another one at 2000 just to say, hey, screw the hedgies, and thank you guys for tuning in, even though today, live streaming, what a chore. What a pain today. Okay, there it is. But you guys, even if you didn't win, you're immortalized as someone who'd played in the trivia, and that just means you're a real cool person. All right, once again, if you guys haven't gotten the, if you don't know that this is Webull, this is a trading application that gives you more leverage as a beginner trader or even an expert trader alike, and it's entirely free. Gives you the opportunity to control the indicators that you want to see. We are in talks with a partnership, just sealed something during today. Send an email, and we are now looking at some brand new indicator technology. So we are excited to reveal some new stuff soon. 12:53 p.m. over on the Pacific Coast, which means we got 7 minutes left until the end of that power hour. And then we will be staying with you guys and unwrapping what happened today. So make sure that you guys are not going anywhere. We'll be going an hour into the after hour. Sean Machado saying, not liking this dip, but by the way, I'm going to need y'all to put this up to 70 so my $60 calls run in the money. Right? He wants to be premium neutral. Mab3 Ref, do you recommend buying XPL? It's at 66 cents. Penny stocks, that hurts my like belief that certain markets run in the same patterns, right? Penny stocks, I try to stay away from as much as possible, but hey, if you did want to be able to run it on, let's say, Code Algorithm or some other software for now, or Ortex, right? Those links are all in the description down below. How many monitors am I using? Wow, it's just there, that one, this one. Meatball's a monitor. He has 2 on his eyes. I'm currently running 3 monitors, including the laptop. 1 after market hour. Boom, boom, says Nick Lopez. Candle incoming, buy the rips and hold. As a reminder, guys, we are looking at GME facing the simple moving average, and we're not going to flinch. This is an opportunity for GameStop to bounce clean off. And if it then has the opportunity to retake 231, well, it's going to be not only green in the day, it's going to flourish. Already up 1% after spending all day in the red. Asadran says, increase my AMC by half at 52. Thanks, Edgies and Paper Hands. Don't know who y'all effing with. Tweet. This dip isn't too bad. Better than the 40s. This dip was all the way down to 51.86. After a clean jump from there, we have been hanging around 55 for the last 15 minutes of Power Hour. After getting rejected at 55.75, currently we are just 75 cents away from pushing all the way past and over this level of resistance. Lickfield, Wakefield, up and away to the moon. Valeria says, gotta watch the after hours. That's true. We're going to dive into more of the Ortex data that we didn't see earlier today. That bounce is coming. A strong, slow candle. Taking its time. We have a candle off of 224.77. It is currently $1 and a change over it, and thinking about whether or not it will retake at 228.60 high of the day. Oh, is so cute. If you guys haven't noticed, he is the cutest. NJ says, I'm completely new to trading. Is this day trading or swing trading? This is... Are you talking about the price action here? I'm imagining that some day traders do swing in at the very end of the day and try to take as much profit as they can before the markets close. So usually if there's a paper-handed action in the end of the day, right? If we can't chalk it up to perhaps a short ladder attack because we're on the SSR list, then we can chalk it up to either a different type of hedge fund manipulation or greedy little day traders coming in and inciting our scissors in the chat. What? How many in the money over $50 right now? Let's take a look at the AMC Stonko tracker. Currently at $55 and change, we have 426,000 calls expiring this Friday alone, right? We're looking at some substantial in the money calls. Just 3 minutes left, and we're going to give you that bell, then we're going to give you that Ortex, then we're going to give you that Stonko tracker, which is feeding from iBorrowDesk. They're not borrowing shares anymore. They're keeping all of that available, and the cost to borrow low, so low. In fact, we haven't seen single digit, like 1%, 2% in, if not weeks, I would say months. We haven't seen it since AMC started getting 100% utilization day in, day out. All right, so here's what we're gonna do. I was following Orphazyme all day. They halted multiple times for going up too fast, right? These are automatic stops. and they do follow with the price action of a stock that is very volatile, to say the least. I was expecting it to be either 20 or 100 at this point. It was at 70 when we looked at it. Now it's at 63.58. Not suspended. So it's going and staying around that 60% up. Started the day at around $10, all the way up at 16. AMC has about 1 minute left on the day before it closes at 6% down. GME had the opportunity to stay green for the day. Is currently just a margin of error away from being green. George V says, good day overall. Hedgies burned a lot of their ammo for almost nothing and lost millions again. It costed me nothing to hold. George V, you're going to be part of the video that we're going to make in just a second. George V. All right, I think that's going to be that. Okay, where's my bell? There it is. 3, a 2, a 3, 2, 1. Ow, my ear. All right, let's get George V up here. We're going to take George's comment. Cost them millions to do what they want to do. Cost you nothing to hold. Okay, let's make this video, y'all. We're staying an hour into after hours at least, so get comfy. Moon Platoon, Meatball is right here. It's almost like a jump scare, except it's like an awe scare. George V is asking, good day overall. Hedgies burn a lot of their ammo for almost nothing and cost millions again. It costed him, and perhaps you, nothing to hold. We're here to give you guys the rundown of what happened on AMC, especially the options chain and how much money Ortex says that the baddies have lost. My name is Andrew, and if this video isn't up to 1,800 likes yet, then let's bump up that like counter for getting more apes on this video and watching to the end to make sure that you know how to prepare for quadruple witching day and tomorrow's day of trading. It's after hours with Andrew. The market's just closed, and I wanted you to look at Ortex's tweet on the day 8 hours ago. Short sellers have lost $1.1 billion in AMC since Friday. So that is less than 4 trading days ago. If you can imagine, that's pretty intense. Estimated short interest is currently 13.1% of the free flow. We have that covered here. AMC gives us the Ortex data that is 85% scanned throughout the market. We had seen small fluctuations, but nothing but up for AMC's short interest. At the end of this video, we'll also cover GME, so make sure that you are not going anywhere. Don't sleep on it, because today had a final run-up that was very bullish, and we're going to have to cover it in just a second. First thing you'll notice about AMC is that it had a much worse day at its lowest, right? We are looking at whether or not these bullish patterns were supposed to continue, or whether or not they were rejected at the right points here. AMC options chain here, we have $40 strikes in the money. These are part of the speculation that in the money calls are used for Citadel and other market makers to transfer FTDs around. We're calling FTD cycling. This is deep in the money calls, which earmarks these shares that are actually synthetic longs back to the hedge funds that shorted a stock nakedly, and that resets the failure to deliver clock. Jesse, I'm going to cover your question in a second. June 16th, you'll expect, well, the DTC 005 is in place, must have something to prevent these deep in the money cycling again, or at the very least, it would be very foolish of them to try and attack the stock in the exact same way and use the same backdoor deep in the money calls to be able to do the same infinite naked short glitch. Well, if you think that that's dumb, then you clearly don't think too much about the hedge funds here. We're opening up option Sonar to take a look at today. We have another $22 million worth of calls at $40 strike. right? So it's either the hedge funds knowing that they cannot keep the price of AMC down for too long and taking the piece, right? Chess analogy. Someone in the chat mentioned this before, taking the piece directly in front of them because it's the only choice that they have, or flaunting and demonstrating their manipulative power because it seems like the SEC will soon have to make a decision. Turn your back on the apes by just willfully overlooking the evidence that we've been piling up for months, or go ahead and find the right guys and give them what's for. Another piece of information is that now we are continuing to look at the far right side of the options chain. An additional $8 million of calls have just been added to 145 strike. The reason why we were looking so intensely at this is because this is tracked based on a finite number of days, right? Ever since the June 2nd or 3rd gamma squeeze, we have been seeing an increase in the sheer size of the options chain at 145 bullish behavior of where the second gamma squeeze is going to finish up at 145. So make sure that you have that number in your head. But if your prerogative is not to lose a bunch of money, don't play the far end of the options chain unless you are sure that the price of the stock is going to roll up to that level, right? I know that calls is much closer to gambling than just holding a normal long position, but if you are looking at the options chain in a way of one, getting more shares and making sure that the options chain is plump and fat for a future gamma squeeze, then you can consider at the money or perhaps slightly in the money calls, because those are much safer and allows you to be able to play off of hedge fund manipulation with more security. That said, I'm not the guru on options. Tiblio is. Go ahead and get into the description and check their platform out in the description down below. And if you guys didn't know that this is Webull, gives you 2 free stocks in the description down below. And BlockFi gives you $250 of free Bitcoin if you guys click that description down below. Super easy. Okay, now that we understand where this is coming from, let's just talk about the sheer size of the options expiring this Friday. 426,000 calls expiring this Friday. Just to give you a little bit of comparison, we can use Stonko Tracker to look at how many options for the next week, right? 55,000, the next 36, 10, 80, 1,000, all the way in July 30th. This is because of something called quadruple witching day. Happens 3 months, once every 3 months. And the last time we saw this, we were expecting great things from GME's price action because an ETF that had a majority of GME inside it was getting rebalanced. We thought that that was bullish AF, and we were ready to be jacked to the T's. That point was a bait and switch. Our perception was shot and we missed the bag, right? We fumbled the bag here. So the battle is a battle of perception, and you want to make sure that you don't mess up a positive bullish indicator because of a bait and switch in the near future. Now, the first thing that I'll say about GME's price action is that we zoom out. We've been following a cup for the last few days. Let's get rid of these blues and go with some yellow. You'll be able to see that from the March gamma squeeze, we traverse a very smooth bottom and then come up right at the same level on the June gamma squeeze. This is GME's price action following AMC's, but not necessarily facing a full-on gamma squeeze, and then a downtrend in the handle. So a couple of ways to identify a good cup and handle pattern, right? Because the continuation of this pattern is something in the next few days or even weeks of a explosive upward growth. Now, this is actually this you might see as the left side of this pattern actually is the right side of a cup and handle that we have been calling since January. So history may repeat itself again. This pattern may easily break out, and here's a couple of ways that it can. One, if this pattern fails, we could see the handle dip further than 2/3 down the side of the cup, right? Usually we want to be on the 50% mark here. It's already past the 50% mark, so this would be around the 2/3 mark here. If it goes any deeper than $200 or lower, then we are likely going to lose this pattern. So we are facing consolidation, but squeezing the price down to 224 is actually bullish for the cup and handle pattern right here. The next part of how this pattern could fail to play out is whether or not we have a smooth enough bottom, right? This usually has to be a long, lengthy, smooth bottom for the cup in order for the potential bullish pattern to play out. However, I will say that usually these will have to play out from anywhere in 2 weeks to 3 weeks to several weeks or months. One of the more noticeable cup and handles that I played out like when was all the way back in the aughts, the 2000s, and you would have seen a cup bottom that expanded the length of months, if not years. So these much quicker patterns could be a result of unexplained manipulation rather than a bullish pattern that forms naturally. Let's go back to that minute by minute price action. One of the things that you will notice is that a lot of the price action has been bouncing between more and more consolidated bands of resistance and support. For GME, we have just been playing with 212, for example. You have multiple touch points here. The birth of a brand new resistance is a sign that we are going to start setting up shop and live and this price action longer this time around and the next time we come back to this price action. But for AMC, we are just dotted with support and resistance points of the price where there will be contention because there were multiple points where that acted as a pivotal moment for the price action, either up or down. That's usually where you are able to identify strong bounces, such as here, 1, 2, 3, 4, 5. When you see the price reverse at the first sign of a price action, that is an easy way to be able to build those levels of support. But this can easily become resistance in the near future. The stock market, these tend to reverse, vice versa. So one of the first things that you'll have to look at tomorrow morning is that options chain. Next thing is to make sure that the Ortex data short interest is staying up above that double digit, which AMC has been, and GME, although it has started to dip slightly. GME was at the 18% range all the way up to just 2 or 3 weeks ago, where now it is for the first time dipped down to below 16%. So it's currently down at 15.3. Keep a close eye on that short interest. Anything above 10 is still a great potential for the short interest, but I've talked your ear off. I wanted to say thank you for those of you who have won raffles in the past. We do raffles throughout the day, thanking you guys for 100K subscribers and the fact that 100K is not a meme. Go down in the comments and tell us if you want a shirt just like this, because we'll put it up there. AndrewMoMoney.com is the merch store, and we have a bunch of deals running that are going to end this Friday. So go check that out, and we'll see you in the money. Oh man! So now we're going to talk a little bit about the other aspects of today's price action, including whether or not 005 is something that we can critically read together, and that's something that I believe too many people have misinformation about. I'll start off with something that my mods have sent me. The moderators, throw some rockets in the chat, because they not only go through the DD, but they also constantly work tirelessly, and they don't get thanked enough. Thank you guys. Okay, let me see what Resort Dog, Kyle G, Alina, Rasul, and the rest of you are saying in the chat. New Market Watch FUD article, why a crash in meme stocks AMC and GME looks more likely now. Ah ha ha. We have found you. So let's see, Dow Jones slips with Fed announcement due. Apple gains, AMC stock plunges as meme names fall. Okay, so meme names fall 2 hours ago. Cautious European close. Just made Coca-Cola interesting. Okay, Cristiano Ronaldo. AMC a buy or a sell right now. Okay, so the Market Watch article must be on the GME side. Remember, Webull also gives you access to like the most relevant news for a given stock, which can be very helpful. Okay. Vernon Jeffers coming in and saying, hey Drew, with the SSR in effect, hedges won't be able to continue a ladder attack for T+2, correct? Only on the uptick. It's the the day of and the next trading day. And SSR only gives us a minor protection. In fact, the insurance that it provides often has a net negative effect because people are more loosey-goosey, they're less cautious when the SSR is on alert. Let's see, meme stocks, a false market will cause radical shift for cinema industry. Ooh. This is the man group. Okay, WallStreetBets stocks lower as AMC, Clover Health, and BlackBerry drops. Take a look at this Orphazyme stock though. Up stayed at 1621 at the end of the day. Just incredible. Oh my god, ducks and rockets in the chat. Cody Sensney, I want one that says 1 millions is not a meme. So you want a shirt that says 1 million is not a meme. Okay, that's the next subscriber goal, by the way. So those of you that have not yet hit that bell button yet, I know a bunch of you have subscribed. Go check on whether or not the bell is hit. So important. That's my new campaign this week, is making sure that all of you have smashed that bell button. And let's do this, right? I'll check my public records. If you have publicly smashed that bell button, right, show your subscriptions publicly, I will have a brand new raffle coming up soon that specifically deals with whether or not you've smashed that bell button. So go ahead. This is a good chance to get bonus brownie points. Okay. Meme stocks, a false market. Let's take a look at this mainstream media shenanigan. The rise to the prominence of so-called meme stocks, as if we were the ones that said these are memes.
Run with it, so it's probably here for a while. Look, for us, we use technological screening, and you know, you can obviously have a look using technology, using sort of natural language processing things at all the stock tickers which are being talked about on the sort of WallStreetBets and the other Reddit sites. And yes, you can read what they're doing with emojis and so on, and basically use it to avoid trading the names that they're super excited about, because they're mostly creating false markets. I think it becomes really interesting when companies then take advantage of what are otherwise false share prices and issue stock. And, you know, I think we're going to see a radical shift in the cinema industry because, you know, one of the cinema chains has been able to use the pumping of the stocks on WallStreetBets in order to then go and raise capital. And that's going to put them in a significant competitive advantage with other people in their industry. So you have to observe it, you have to deal with it. But as a sort of institutional investor, frankly, we just avoid those stocks and move on to other things. The good news is, you know, there are sort of 6, 8, 10,000 stocks out there in the world that we're interested in trading. So it's easy to avoid the ones where we think it's a false market.
Okay, so I would say right now that narrative is probably running rampant, as that these meme stocks are getting what they deserve. As a reminder, if we wanted to belittle ourselves and call us meme stocks, well, that is our own prerogative. We need to start changing that mindset. Maybe we should call them ape stocks. I'm not sure if that gives more gives us more like professional branding here. Okay, one of you, Monday Crawford in the chat, talked about a shirt that would be designed like this, right? What do you think? So it'll be like AMC and GME and Meatball and Andrew Mo Money. That sound fun? Like one of those shirts that people have, just a graphic black shirt. You know? Okay. That's a fun idea. We have a lot of fun ideas that's just white text on black shirt. Jesse? No, what? Say it again.
Why the 4 million at
4 million at the end of AMC's trading, right?